So in this video, I'm going to go through a little bit of what I talked about here. I'm keeping, like I asked or suggested, I'm keeping this geography that I laid out by the side of the text here. Remember that we're talking about a multiple step income statement where we have this idea of persistence. Items that are more persistent are presented at the top of this income statement. When we go all the way down, we get to discontinued operations. These are not persistent items. Obviously, non-operating items, items that are not central or ongoing in core operations, are going to be less persistent than those that are core and central to operations. This allows us to draw interpretations on that persistence, right? So let's talk about the layout a little bit more. As I hinted and drew out on that page, we have before tax items, and that's really separated into two overall sections: an operating section, a non-operating section. If within the operating section we have sales or revenues, that's always the top line. Notice that I call this net, and just as a flag, that means that we do have some eventual contra revenue accounts that we will examine that will be deducted from our net sales or from our gross sales to get net sales. So that goes, whenever you see that word net, think contra adjunct accounts that might be at play. We also have cost of goods sold. Cost of goods sold will only arise for inventory based companies. So if the profits of the company are generated through inventory sales, whether that be a manufacturer, a wholesaler, or a retailer, that's when we see cost of goods sold. And then the third section, which includes the most, as you can see, the absolute most number of items, is the selling, general, and administrative expenses. Now, this is usually captured as one line item on an income statement, but it includes tons of things. So what's the difference between a selling expense and a general or administrative expense? Selling expenses, right? Anything that are used in generating sales. I have a ton that I'm not going to read through. You can read through them on your own. You can take a moment to do so. Pause the video if you must. But basically, these are expenses that change with sales volume or are most closely tied to sales volume. So if I have a rise in revenues, these are the expenses that are most highly correlated. They will rise almost not on a dollar per dollar basis, or else we wouldn't be making any money, but these will be tightly correlated to the revenues as they rise as well. Now, general expenses tend to be more of a fixed relationship with sales volume. We might have huge amounts of sales, but our payments to executives are not going to change. Our salaries paid to the accounting staff of the company are not going to change with increased sales. Our utility, our rent based on, not selling locations, but just company headquarters. Insurance costs are likely not to change with large increases of sales. And so we sort of have, harkening back to managerial accounting, sort of a variable and fixed cost analysis going on here in our SG&A. Beyond that, there are some operating expenses that are, when they are present, will almost always be separately line itemed. And when we talk about line iteming items being presented as a line item, that means that they get a separate line on the financial statement to draw attention to them. Notice we don't draw very much attention to the difference between the amount we paid our employees versus the amount we paid our managers versus the amount that came from bad debt expense versus the amount that came from our rent to showrooms and sales locations. That was just all contained in this catch-all thing. But we have very specialized items that we want to call attention to. We separate them out. Depreciation and amortization is usually one of these items, because it can help us assist in creating our common subtotals that are used, for example, in Wall Street. One of those is called Ebitda, which is earnings before interest, taxes, depreciation, and amortization. And so it takes our net income, adds back interest, adds back taxes, adds back depreciation, adds back amortization. So that's one item that a lot of investors use to depict profitability rather than accounting earnings. Within this, too, are three other items that are almost always line itemed. One of them is research and development. Research and development usually disclosed separately because we want to draw attention to those expenses that may give rise to extremely profitable items for the business in the future. This is of obvious importance to certain industries like tech, biotech, pharmaceutical industries, where patents and processes are extremely lucrative to their future profitability. Remember that when developing these items, they are not allowed to record assets, that all R&D is expensed immediately. And so they want to highlight it separately so that people understand if there's a huge drain here, then it's probably, hopefully, going to produce an asset in the future. There's also research that suggests that investors do not view this as much of a mark against a company as other expenses. So we'll talk more about it in class, but not all expenses are created equally in the eyes of investors. You might, for example, see a huge expense for R&D and think, all right, well, I'm not going to weight this as much. I'm not going to weight it a full dollar of an expense because actually some of that is going to translate into future profitability, unlike the amount of money I pay for rent or the amount of money that I pay my employees. That might be seen as a more weighty expense when you're considering the company's operations. Restructuring costs. Restructuring costs are one-time bulk costs. They might not be one time, but they're going to be for a very limited time. So we might have them for, 3 quarters in a row, or maybe even up to 2 years in a row. But what we're doing here is retooling or streamlining operations to increase future profitability. So again, this has a bit of a relationship, much like R&D, to future increases in productivity and efficiency in creating profits. I compare them to a corporate rebuilding or maybe like a corporate facelift or liposuction. We're cutting out the fat, right? We're going to move improved and more efficiently in the future. Impairments, we're going to talk more about in discontinued operations, but impairments happen when we have a change to the value of an asset because of some forecasted loss in the value of those assets. So what we're talking about here is every asset is an economic benefit. Well, when there's been a dramatic change to the future economic benefits we think we are going to be able to extract from an asset, like if we have machinery and all of a sudden some law was passed to regulate the usage of that machinery such that we can't operate it as vigorously or as for prolonged periods of time, and that's going to scale back the amount of profits we're going to be able to generate from it, then we would need to write down the value of that asset because its future economic benefits are not as substantial as they were at one point in time. So that highlights the operating section. The non-operating section has, again, those more transient activities that don't necessarily relate to core operations. A lot of them are from financing and investing activities. For a majority of companies in practice, this is going to be a lot of interest expense. However, there are other items that can be classified here. If we have sales of components of the company that are not discontinued operations, that would be one. Any sales of fixed assets, intangible assets, or long-term investments. Any of these are investing activities, whereas interest expense is a financing activity. If we have any interest revenue, that would be an investing activity. And in fact, a lot of times, interest expense is presented net, which is just the net of the company's interest expense and interest revenue. These guys are all resulting from investing activities. Right. After that, we're done with the above the line items. We have tax expense, because that's the line. Remember, it's just the tax rate applied to all our pre-tax income, which arises from both operating expenses or operating activities and non-operating activities. We get a tax expense line item, and then we move into the after-tax components. So these guys that occur after tax include discontinued operations and other comprehensive income. These are gains and losses that are not included in net income. We'll discuss those later. These typically involve advanced accounting transactions like hedging, available for sale security, unrealized gains and losses from available for sale security transactions, translations of foreign currency, pension items. So more things we haven't necessarily talked about in class, or you haven't talked about in your principles class. And then any discontinued operations are also after tax. A lot of this is due, again, to the fact that these are not persistent indicators of future net income. Or any future flows. Obviously, they're not because of net income, because they're disclosed after income. You might think, well, that's stupid because by definition, they're not in net income, not income. No, that's not what I mean. It just means that in terms of the overall income, these do not tend to correlate with what's going to happen in the future. What is that? Oh, also that these guys are presented net of tax. So because we're not including them in this income before taxation summation, right? This means that this only has been taken from all of the revenues and expenses that we've realized up to this point, right? This is an aggregation of all the revenues and taking and subtracting all the expenses and all the non-operating items, positive and negative, to get to a subtotal. This is basically my pre-tax income. Then we apply a tax rate to get this item right here. These numbers, income and loss from discontinued operations, any other comprehensive income, which would come in down here, those haven't influenced this number, and so they're not included in my tax expense here. Therefore, we need to take tax out of them separately. These items up here are all pre-tax because we're going to take one big tax expense based on all of their values summed together. Right? But these guys aren't a part of that summing, and so we have to take the tax out separately. Everything gets taxed regardless of where it is on the income statement. The question just becomes whether their tax effect is going to be disclosed here on this line item, because this is the tax effect of only those things that are above the line, or whether we have to take them out separately because their tax effect was not taken out here. We got to take it out net of tax, net of tax. I'm going to stop the video there. We're going to jump into examples of discontinued operations, and that'll be module 5.2.